Hello, everyone, and welcome back to Synaptic Investing. I hope you're having a fantastic week and are ready for another deep dive into the mechanics of the market.
Yeah, it is going to be a fascinating one today.
It really is. We are absolutely pumped to have you with us today because we are looking at a situation that is equal parts fascinating and, if I'm being perfectly honest, completely terrifying from a capital preservation standpoint.
Terrifying is definitely the right word for it.
Right. So today we're breaking down one of the most interesting, albeit distressing, companies on the market right now, and that is the clinical diagnostics company Trinity Biotech, PLC, ticker symbol TRI.
Sure, right.
Now, if you haven't heard of them, don't worry. I mean, this is a microcap situation. They're currently sitting at a market cap of around $14.3 million.
Barely a blip on the radar for most people.
Exactly. It is flying completely under the radar of the major institutions. You aren't going to see a lot of coverage on CNBC about this one.
No, definitely not.
But, it has become something of a battleground, or perhaps a casino is a better word, for retail investors who are hunting for that elusive, explosive turnaround play.
Everyone wants to find that 10-bagger at the bottom of the barrel.
Right. And on the surface, this looks like a classic value setup. I mean, you have a company with FDA approvals, World Health Organization pre-qualifications, and a genuine foothold in massive global markets. We're talking HIV testing and diabetes management.
These huge markets.
Massive. And yet the stock is trading at just $0.74. So the central question, the real promise of today's deep dive is this. Is that a deep value opportunity where the market has just overreacted and left a dollar trading for 70 cents?
No.
Is it the moment to back up the truck? Or is this a value trap spiraling toward a 100% permanent loss of capital? Are there hidden cracks in the fortress that the market is completely ignoring? That's what we're here to find out.
That's a huge topic, and frankly, a really dangerous one if you don't know exactly what you're looking at. Before we dive deep, a quick heads up for the audience.
Right. If you're looking to invest, whether it's in volatile microcaps like this or the titans of the industry, we use Interactive Brokers. Use the link in the description for a stock bonus when you sign up.
It's the best way to get a bonus, access professional-grade execution, and support the channel at the same time.
And while you're there, please like, subscribe, and let us know your questions in the comments. We literally read every single one.
We do. Now let's get right into it. Pillar number 1, the business model.
Okay, let's unpack this black box. Because when we strip away the start price, the volatility, and all the retail noise, what does Trinity Biotech actually do?
Right. What's the actual engine here?
Yeah, because on paper, the portfolio sounds incredibly impressive. They are a developer and manufacturer of clinical diagnostic products.
Which covers a lot of ground.
It does. We're talking about rapid HIV testing with products like TrinScreen and Unigold, HbA1c analyzers for diabetes monitoring, and various autoimmune diagnostics.
Correct. And to understand why this stock is trading where it is, why it's at 74 cents, you have to understand the transaction model underneath those products.
Walk us through it.
It's the classic razor and razor blade model.
Okay, yeah.
In the diagnostics world, you place the hardware, the analyzer, into a lab, a hospital, or a rural clinic. Often, you do this at a heavily subsidized rate.
Or they just give it away, right?
Exactly. Sometimes you give the machine away for free in what's called a reagent rental deal.
Reagent rental.
Yeah, because the goal isn't to make money on the metal box. The goal is to secure a long-term, sticky, recurring revenue stream from the high-margin consumables.
The blades.
The blades. The reagents, the test kits, the specialized chemicals that the machine absolutely needs to run every single day.
Which, logically, is usually a fantastic business model. I mean, look at standard office printers, look at Gillette, look at Nespresso.
That's proven concept.
Right. Once you're locked in, you're a captive customer. You can't just pour generic Folgers coffee grounds into an espresso pod machine without breaking it.
You void the warranty immediately.
Exactly. So where does it get complicated for Trinity? Why isn't this model just printing cash for them?
It gets really complicated when you look at the quality of that revenue. The razor blade model only works if you actually have pricing power on the blades.
Okay, meaning you can charge what you want.
Meaning you need to be able to raise prices on those consumables without the customer getting frustrated and just ripping the machine out of the wall.
Right.
And when we look at Trinity's recent performance, specifically regarding their unit economics, that pricing power appears to be practically non-existent.
Let's really dig into that, because we saw in the data that they attempted to pass on some input costs via price hikes back in late 2023 and early 2024.
They tried, yeah.
Inflation was hitting literally everyone. Raw materials were up. Global logistics were a nightmare. So they naturally tried to pass that cost down to the end user. Did that stick at all?
It didn't stick enough to save the merchants. In fact, despite those price hikes, we're seeing gross margin compression. And here is the smoking gun, the real anomaly that really worries me when I look at this business.
Yeah.
The TrinScreen paradox.
TrinScreen. It sounds like a generic sunscreen, but it's their new rapid HIV product, right?
Exactly. And TrinScreen was heavily pitched to investors as the ultimate savior of the company.
The golden goose?
Right. It was the major growth driver. The entire narrative was, we have this new WHO pre-qualified test. We are going to win huge global tenders, and revenue is just going to fly.
So what happened?
Well, when they actually started scaling it, it pressured gross margins downward.
Wait, so the new product, the supposed highly engineered growth engine, is actually less profitable than their legacy products. That seems completely backwards. Usually you innovate to expand your margins, not compress them. I mean, Apple doesn't release a new iPhone to make less money per unit.
Precisely, and that tells you literally everything you need to know about the competitive landscape they operate in. They had to price TrinScreen lower just to gain market share, because they are operating in a highly commoditized bidding market. When you are selling into massive global NGOs, the World Health Organization, or large national health systems in developing nations, you aren't selling to a consumer who cares about the shiny brand.
No, they don't care about the logo.
They don't.
Yeah.
You are selling to a procurement officer running a massive spreadsheet in Geneva.
Right, they have a strict checklist. Does it work? Yes. Is it approved by the regulatory bodies? Yes. Is it the absolute cheapest option available?
That is the only question that actually matters on that spreadsheet. Is it the cheapest? When your product is functionally similar to 3 other competitors like Abbott, Roche, or various generic manufacturers, you don't dictate terms.
You're a price taker.
Exactly.
Yeah.
You take the price the market gives you. They lack the leverage to walk into the room and say, this is our price. Take it or leave it.
Because if they say that, the NGO just shrugs and buys from Abbott.
And Abbott can afford to discount because of their massive scale. Trinity can't.
That's a terrifying place to be as a business. You're running faster on the treadmill just to stay in the exact same place. It's a literal race to the bottom on price.
And it destroys capital.
But let's play devil's advocate and talk about the defense for a second. Usually in the healthcare space, the moat is regulatory.
It is, yeah.
You can't just start making HIV tests in your garage and selling them on Amazon. You need clearance. Trinity has WHO pre-qualifications and FDA clearances. Isn't that a fortress? Doesn't that protect them?
It is a moat, but I would argue it's what we call a fragile cornered resource.
Explain that.
Yes, the regulatory hurdle absolutely prevents me or you from entering the market tomorrow. But it doesn't prevent the giants. It doesn't prevent an Abbott or a Roche who have literal armies of regulatory affairs people and lawyers.
Right. For them, an FDA approval is just a Tuesday.
Exactly. And more importantly, the real anti-moat here is technological disruption. The diagnostic space moves incredibly fast. Yeah. Faster than people realize.
It feels like every month we hear about a new, faster, cheaper way to test for something. Lateral flow, molecular CRISPR-based diagnostics.
Exactly. And when you look at Trinity's current operations, you see signs of sheer desperation, not technological strength. They have been aggressively offshoring their upstream manufacturing to lower-cost geographies.
Now, a bull might look at that and say, oh, well, that's just optimizing for efficiency. Smart management.
Sure.
Right? Cutting costs to boost the bottom line. It's the standard corporate playbook. Jack Welch 101.
But context matters. In this context, when you combine it with the severe pricing pressure we just talked about, it looks a lot more like cutting costs just to survive.
Not to grow.
No. It indicates a massive lack of structural process power. If your only way to maintain baseline profitability is to constantly chase cheaper labor arbitrage, moving from the US or Europe to cheaper jurisdictions, you don't actually have a technology advantage.
You're just renting cheaper hands.
Exactly. You are fighting a commodity war. You are trying to squeeze blood from a stone.
That's a crucial distinction for listeners to grasp. Optimization versus desperation. And I think that bleeds perfectly into the soft power aspect of the business, the brand, and the internal culture.
Which is often overlooked.
Highly overlooked. We always say on this show that the financials are just the lagging indicator of the culture. What are we seeing inside the building at Trinity?
It's highly concerning. If you look at the legacy products, things like Unigold, There is definitely some stickiness there. Doctors know the name, labs have used it for years.
Habit is a powerful force.
It is. But their core clinical laboratory revenue dropped nearly 10% year over year recently. That's a massive red flag.
Okay, let's pause there. Why is that specific 10% number so alarming? Because in retail, a 10% drop might just be a bad quarter. It doesn't sound like an immediate death knell.
In retail, no. In the clinical lab space, it absolutely is.
Yeah.
Changing out diagnostic equipment is a massive, massive pain for a lab.
It's a whole ordeal.
Oh, yeah.
Yeah.
You have to retrain your entire staff. You have to clinically validate the new machine. You have to update your laboratory information system, the IT side.
So the switching costs are huge.
Enormous. High switching costs usually keep customers loyal, even if they aren't completely thrilled with your product. So if revenue is dropping 10%, it strongly suggests that the switching costs are no longer high enough to hold those customers back.
Wow.
They are actively choosing to go through the severe pain and expense of leaving.
That is telling. And if the customers are willingly enduring that pain to leave, what about the employees? We've seen a bunch of restructuring announcements from them recently.
That's the other side of the coin. When you look at the inside view, things like Glassdoor reviews, employee sentiment, and the sheer nature of these restructuring announcements, the culture appears to be entirely defined by survival mode.
Just keeping the head above water.
Right. They're consolidating plants, physically moving operations from places like Kansas and New York over to offshore facilities.
That sounds like a perfect recipe for a massive brain drain.
It is a textbook brain drain. You lose the tacit, deep institutional knowledge. The senior engineer, who has been there for 20 years and knows exactly how to tweak the calibration on the machine when the factory humidity rises.
He's gone.
He's gone. The supply chain manager, who has the personal relationship with the key chemical supplier, she's gone.
So you replace them with who?
You are replacing deep, specialized expertise with outsourced, generalized labor just to save a quick buck. That distracts the entire workforce and usually leads to severe quality control issues down the line.
I can imagine.
It's very hard to innovate or care about product quality when everyone in the building is looking over their shoulder, wondering if their plant is next on the chopping block.
So to summarize Pillar 1, we have a business model that is structurally challenged by commoditization, a regulatory moat that is rapidly drying up, and a corporate culture in total turmoil.
That's the reality of the business engine.
That sets the stage perfectly. But now, let's look at the actual scoreboard, because ultimately the numbers don't lie. Let's move to pillar number 2, financial resilience and capital allocation.
Yeah, this is where the rubber meets the road.
Yeah.
And frankly, this is where the value trap alarm bells start ringing the absolute loudest.
It gets worse.
If Pillar 1 was the storm warning, Pillar 2 is the Category 5 hurricane making landfall.
All right, let's start with the quality of earnings test. We mentioned margins earlier, but let's put a hard number on it for the listener. How bad is the bleeding here?
It's abysmal. We are tracking their operating margins in the range of negative 27% to negative 31%.
Negative 30%.
Just think about the physics of that for a second. For every single dollar of revenue they bring in the door, they are losing roughly 30 cents just on the basic operations of the business.
And that's before debt, right?
Before they pay a single dime of interest to the bank or taxes to the government.
And what about gross margins? Because those are sitting around 35%, which, sounds okay if you're a big box retailer like Target or Walmart. But for a specialized medical device company?
It's terrible. It's truly bottom tier.
Yeah.
Medical devices usually command 60, 70, sometimes even 80% gross margins because of the sheer R&D intensity required in the space.
You need the cushion.
Exactly. You need those incredibly fat margins to pay for the science and the clinical trials. So a 35% gross margin fully confirms that product mix shift we discussed earlier.
They are selling the cheap stuff.
They're selling cheaper, lower margin items just to keep the top line revenue flowing. They are moving a lot of product, but they aren't actually making any money on it.
But here is the metric that literally made my jaw hit the desk when I was prepping for this deep dive, the dilution. We always warn our listeners about dilution risk on this show, but this is on an entirely different level.
It's a total catastrophe for the equity holders. We're looking at roughly 171% year-over-year growth in outstanding shares.
171%. That's not dilution, that's vaporization.
It is. Let's use a really simple pizza analogy for anyone new to this concept.
Always love a pizza analogy.
Imagine you own a slice of a pizza. The pizza has 8 slices total. You own 1. So that's 12.5% of the company.
Makes sense.
Suddenly, the chef comes out of the kitchen and, without making the pizza any bigger, cuts it into 22 slices.
Right.
Your physical slice hasn't changed its original size, but your percentage ownership of the whole pie has completely collapsed. If you owned 1% of Trinity Biotech a year ago, you own less than a third of that stake today, and you didn't even sell a single share.
And usually companies dilute for a somewhat defensible reason, right? I mean, good dilution is when you issue shares to buy a highly profitable competitor or build a massive new factory that will double your output.
Correct. That's issuing equity to invest in growth. What Trinity's doing, this is pure survival dilution.
Just staying alive.
They are issuing shares essentially at the market just to keep the lights on and pay the daily bills. They're literally selling equity to fund operating losses.
Wow.
It's like selling the bricks off the outside of your house just to pay your monthly electric bill. Eventually, you run out of house.
And what about stock-based compensation, or SBC? We usually heavily scrutinize that when management is paying themselves in stock while the company burns.
The absolute number for SBC actually looks fairly moderate here, around $428,000.
Oh, that's not crazy.
No, but it's deceptive. When you combine that executive comp with the massive, broader share issuance to fund the basic operations, the retail shareholders are just being hit from both sides. But honestly, the real North Star metric we need to focus on is free cash flow.
FCF, the ultimate truth serum of the stock market. Earnings can be manipulated with accounting tricks. Cash is an absolute fact.
And Trinity completely fails the test. Their free cash flow is severely negative. The core business engine burns cash even before you adjust for that SBC. There is zero actual cash generation happening here. It is a cash incinerator.
Okay, so the core engine is fundamentally broken. Now, let's apply one of our favorite mental models on the show, inversion. Instead of asking, how much can this stock realistically go up? Let's ask the harder question. How do we lose 100% of our money here?
This is hands down the most important exercise for any microcap investor. The pre-mortem. How does Trinity actually die? And the answer is sitting right there in plain sight on the balance sheet. The debt load.
Walk us through the numbers on that. How deep exactly is the hole?
They currently have over $73 million in debt on the books.
Okay.
Now, remember what we said at the start. The entire market cap, the total public value of all the equity combined, is only $14.3 million.
That is completely upside down.
It's inverted. The debt is more than 5 times larger than the entire equity value of the business, and this isn't cheap fixed-rate pandemic debt either.
What are the terms?
We are looking at interest rates exceeding 10%. It's likely a floating rate like SOFR plus a hefty margin because lenders aren't stupid. They know this is highly risky paper.
So let me just make sure I have this straight. You have a company that is actively losing money on operations with negative 30% margins. They are heavily burning cash, and on top of all that, they have to somehow service a $73 million debt pile at 10% interest.
Yes.
That's roughly $7 million a year just going out the door in interest payments.
Correct. And where exactly does that cash come from if the actual business operations are losing money?
From the equity markets, for more dilution.
Exactly. It creates a brutal reflexive loop. The core fundamentals are poor, so the perceived risk goes up, which means their cost of capital goes up.
Right.
That high cost of capital rapidly drains their remaining cash reserves. And then those drained cash reserves make the fundamentals look even worse to the market, which makes the cost of capital go up again.
It is a textbook death spiral.
It is very hard to pull out of a dive like that.
That brings us to the pilot of the plane, capital allocation. How is the CEO and the management team handling this absolute emergency?
Well, if this were a corporate finance report card, it would be a failing grade.
Yeah.
We look heavily at ROIC, return on invested capital. For Trinity, it's currently sitting at roughly negative 24.8%.
So for every dollar they invest into the business, they destroy a quarter of it.
The business systematically destroys value faster than it can even raise new capital.
So in that dire situation, the logical move, the painful but absolutely necessary adult move, is to shrink. You aggressively cut costs, you sell off non-core assets, you pay down that crushing debt, and you just focus on survival. Is that what they're doing?
No. And honestly, this is the most baffling part of the entire deep dives. Instead of shrinking to profitability or paying down that massive $73 million debt, management decided to pivot.
Pivot.
They acquired the biosensor assets of a company called Waveform Technologies for $12.5 million.
Wait, hold on. They spent $12.5 million, which is almost the equivalent of their entire current market cap on an acquisition, while they have $73 million in debt and are incinerating cash.
Yes, they are trying to aggressively pivot into the continuous glucose monitoring space, or CGM.
That sounds highly ambitious. Or just reckless.
It's like deciding to completely remodel the kitchen with luxury appliances while the roof of the house is literally on fire.
It makes no sense.
It raises serious fundamental questions about management's judgment. Are they genuinely trying to save the core company, or are they just trying to sell a flashy news story to retail investors because the old diagnostic story is visibly broken?
It feels like a total Hail Mary pass in the fourth quarter.
Exactly.
Well, that is the perfect segue to pillar number 3, growth narratives versus reality. Because despite everything we just laid out, the debt, the margins, the dilution, there are actual people out there buying this stock today.
There's a bull case out there.
There is a bull case. What is the story that these buyers are actually believing?
The current bull case rests on a three-legged stool. First, the highly successful global launch and adoption of that TrinScreen HIV test we talked about.
Okay, that's leg 1.
Second, that massive margin expansion is going to magically arrive from the new offshore manufacturing model, which they expect sometime in late 2026.
Leg 2.
And third, the real blue sky dream. The entry into the AI wearable and CGM market via this Waveform acquisition.
Okay, let's aggressively dismantle these one by one. We already talked about the TrinScreen gross margin pressure, so that first leg is already super wobbly. Let's talk about this AI wearable narrative. Management is throwing around some genuinely massive numbers to support this, right?
Oh, huge numbers. They're loudly touting a $260 billion total addressable market, a TAM for AI wearables.
$260 billion. That sounds absolutely incredible. I mean, who wouldn't want a piece of that pie? It sounds like the kind of slide you strategically put in a pitch deck to get venture capital funding.
Exactly, and this is what we call the classic TAM track. It's a total rookie mistake for an investor to look at a huge multi-billion-dollar market and just naturally assume, well, even if they just get 1% of it, we're rich.
Right.
You have to look at who is actually standing in that market waiting for you.
Who is Trinity stepping in the ring with here?
They are a highly distressed microcap with $14 million in equity value trying to pick a fight with Dexcom and Abbott.
Oh boy.
These are global titans. Dexcom and Abbott have virtually unlimited R&D budgets, deeply established global distribution channels, and incredibly entrenched, sticky relationships with major health insurers and doctors.
Not to mention the tech itself.
Right. Abbott's Freestyle Libre and Dexcom's G7 sensors are absolute marvels of modern engineering. They spent billions perfecting them.
So it's David versus Goliath, but David forgot to bring his sling, and Goliath is holding a laser cannon.
That's a great way to put it. And look logically at the transaction itself. Trinity bought these CGM assets from Waveform for $12.5 million.
Right.
Now ask yourself, if Waveform actually possessed a true Dexcom killer, a revolutionary piece of tech that could genuinely disrupt a $260 billion market, why on earth would they willingly sell it to a distressed microcap for $12.5 million?
That's a fantastic point. If it was real, Apple or Google or Medtronic would have scooped it up for $1 billion in cash tomorrow.
Precisely. In finance, the price tells you the value. This entire pivot is what Peter Lynch would call diworsification.
Diworsification. Making things worse by diversifying.
Yes. You are taking an already highly distressed core company and carelessly stacking a highly speculative, incredibly capital-intensive R&D project right on top of it. The baseline probability of a company in Trinity's current financial state successfully disrupting a medical oligopoly with a cheap, acquired second-leg technology is statistically microscopic.
So you're saying there's a chance?
It's not absolutely zero, but it's close enough to zero that you absolutely shouldn't bet your retirement fund on it.
So if the growth story is essentially a mirage, how do we properly value this thing? It's trading at $0.74 right now. Is it objectively cheap?
Valuation is extremely tricky here because all of the traditional metrics we rely on are fundamentally broken. You can't use a PE ratio because there are no actual earnings. The E is severely negative.
What about revenue multiples?
EV to sales is sitting around 2.67x, which might look somewhat cheap, but remember that enterprise value, which is around $130 million, is massively bloated by that toxic $73 million debt pile.
So how should a rational listener actually think about that $G.74 price tag on the screen?
You have to stop thinking of it as equity and start thinking of it as an option. You aren't buying a proportional share of a stable, cash-flowing business. You are essentially buying an out-of-the-money call option on the company, simply avoiding a formal bankruptcy.
That's a very powerful way to frame it. You're just betting on baseline survival.
Right. If they somehow survive, if they miraculously fix the gross margins, successfully refinance the massive debt at a lower rate, and the CGM thing somehow actually works, The stock re-rates massively. It could go to $3, $5, who knows?
The upside is there.
But the market is currently pricing it at 74 cents because the broader market expects this structural unprofitability to continue. The market is effectively mathematically pricing in a very high probability of zero.
And there's a literal ticking clock attached to this, isn't there? We absolutely have to mention the delisting risk.
Yes, we do. In February of 2026, they received formal non-compliance notices from the exchange.
For what specifically?
Two things. Their total market value of listed securities fell under the $15 million minimum threshold, and their standard bid price has been sitting well under the required $1 mark.
What actually happens if they fail to regain compliance and get delisted?
Liquidity instantly dries up. Institutional investors, the very few that might still be hanging around, are often legally forced by their own internal charters to indiscriminately sell any stocks that aren't actively listed on major national exchanges.
Forced selling.
So they dump it. The stock is then relegated to the pink sheets, the over-the-counter market. It essentially becomes completely untradeable for most serious retail and institutional investors.
The bid-ask spreads just widen out to a mile.
Spreads widen massively. Daily trading volume totally disappears. That event would instantly crush whatever tiny bit of option value is left in the equity.
So we've looked at the broken business model, the absolutely terrifying balance sheet, and the pie-in-the-sky growth narrative. Let's try to put a bow on this and find an intrinsic value. Is there any mathematical way to justify a higher price target?
I've really tried to triangulate an intrinsic value here using three standard methods.
Okay, walk us through them.
Method A is mean reversion. This is basically impossible to run because they have virtually no real history of consistent profit to revert back to. You literally can't revert to a mean that doesn't exist. Method B is analyst consensus. If you look at Wall Street, there are targets out there floating around $3.06.
Hey, that sounds incredibly promising. That's essentially a 4x return from today's price.
But you have to be extremely careful with those sell-side targets. Those models almost always ignore the brutal dilution required to actually survive long enough to get there. They are modeling the perfect execution blue sky scenario. They absolutely aren't appropriately pricing in the 171% share count growth we just saw.
So they're modeling the destination, but ignoring the cost of the fuel to get there.
Exactly. And finally, method C is owner earnings, the Warren Buffett metric. Since free cash flow is severely negative, there are practically no owner earnings to capitalize. Therefore, there is zero intrinsic margin of safety.
So, mechanically speaking, we are flying without a parachute here.
Precisely. If the engine completely stalls, you hit the ground.
All right, we've thoroughly dissected the patient here. Now it's time for the final diagnosis. Let's move to the outro and deliver our final verdict synthesis.
Let's do it.
If you had to officially give Trinity Biotech a quality score based strictly on our internal framework, where does it land?
It's a hard blow.
Yeah.
It fails almost every single rigorous check in our framework.
Break it down.
Filter 1, red flags. Yes, we have extreme diversification with the waveform deal and massive ongoing equity dilution.
Filter 2, the 7 powers.
No durable structural power found. The regulatory moat is highly fragile and easily bypassed by larger competitors.
And filter 3, financials.
ROIC is deeply negative, worse than negative 20%, and free cash flow is completely negative. It just fundamentally does not pass the bar for investment grade.
And the buy zone. At what exact price does this highly flawed asset become attractive to you?
For me personally,
Yeah.
$0. Zero. This specific asset does not belong in a high-conviction, long-only portfolio. It is far too mathematically speculative, and the mathematical risk of a permanent, unrecoverable capital loss is simply way too high.
That is a very harsh verdict, but honestly, looking at that debt stack, it's really hard to argue against it. So what does the future actually hold here? What are the most likely paths for Trinity over the next 2 years?
I see two main paths, creating a severe path dependency for anyone holding the stock.
Path 1?
Path 1 is an acquisition. This is the ultimate save scenario for equity holders. A larger, much better capitalized player buys them out, not for the ongoing business, but purely for the IP and the FDA clearances.
To just plug those tests into their own massive distribution network.
Exactly. Maybe they pay a very slight premium to the total enterprise value just to quickly get their hands on those HIV tests without going through the FDA themselves.
So in that scenario, the bondholders get paid out in full, and the equity holders might get some scraps.
Maybe a little more than scraps if there's a bidding war. but it definitely wouldn't be a massive home run from here.
And path two?
Path two, and unfortunately the vastly more likely path, mathematically speaking, is Chapter 11.
Bankruptcy.
The massive debt pile becomes due.
Yeah.
They physically can't refinance it because market rates are too high and they are fundamentally losing money and they are forced to restructure.
And what happens to the stock?
In that scenario, the senior bondholders legally take control of the physical assets, the HIVIP, the manufacturing machines, the inventory, and the common equity gets completely wiped out to absolute zero.
A very sobering outlook.
It is. But honestly, that's exactly why we do this show, to protect capital. Rule number one of investing, don't lose money.
Absolutely. And that brings us perfectly to our closing thought for today. We often talk about the battle between narrative versus numbers.
It's the eternal struggle in investing.
It is. The most dangerous investment isn't the one that is visibly, obviously failing. It's the one that beautifully sells you a dream of AI and cutting-edge wearables, while the actual financial foundation quietly crumbles under a mountain of expensive debt.
That's the trap.
In this specific case, the objectively cheap price of $0.74 might actually be the most expensive price you ever pay for a stock. Because sometimes the market isn't blindly wrong. Sometimes the bargain bin is full of fundamentally broken toys for a very good reason.
Couldn't have said it better myself. Always check the debt load before you buy into the dream.
Thanks for tuning in to this deep dive on Trinity Biotech. We genuinely hope this helps you navigate the incredibly treacherous waters of microcap investing. We'll see you in the next deep dive.
Stay rational, everyone.